Guys, it's me, Genevieve. I know I posted something on Facebook the other day about the insurance policy that I got for Ariana, and I just want to take y'all through it so you can see exactly how it works. So what I've done here, new insured, I'm going to put in Ariana M, and she's 1 year old, female. This is a Conseco Life Options. That's the name of the company. It's a universal life policy, so it builds cash value. It's a permanent insurance. It's going to last for the rest of her life. It's not going to expire in 5 years or 10 years or anything like that. The cost of it is also locked in, which is really great for us who are budgeting. So the cost of it's not going to change as she gets older or anything like that. As long as once she's older and we transfer it over to her name, she continues to pay it, the cost of it is not going to go up. If she wants to increase the amount of insurance that she has, she can always do that, but it's not going to cost her, well, it'll cost her more at that time, but at this point it won't if she left it the way it is. So of course, standard non-tobacco. My daughter better not be smoking at 1 year old. My gosh. And if you look here, it actually says S&P 500. The reason for that is because it does work with the stock market. This is a really great type of policy. Number one, it offers life insurance coverage for our babies for the rest of their life. Number two, it works with the S&P 500, so the money that you're paying into it is going to be active in the stock market. When things go up, get better, they'll benefit from that. But it also has a guaranteed minimum of 1%. So when things are really bad, hopefully that won't happen. But if it does, there's always going to be guaranteed. So we know that they're not going to lose out on the money that we've been investing in. I know for a lot of people that can be really scary. So the one that I've chosen for Ariana is the S&P 500 Index number 1 option. And when we visit, I'll show you more about how that works. The monthly premium, for me, what I did is I maximized it and I wanted to pay monthly, so I selected that. Excuse me. And I'll show you again more into that in a little bit. For her coverage amount, the death benefit, God forbid anything happened to her, I put 100,000. That's a good basic amount. And then I also went into an income option. For me, I know that Social Security probably isn't going to be around when I'm old, so I definitely know it's not going to be around for Ariana. If I go with this option, and again, everybody's going to be a different situation, I want to have an income for Ariana for her retirement. So let's say from age 65 to 85, for example, I want her to get $1,000 a month from her insurance policy. So $1,000 a month is $12,000 a year. I wanted to pay her monthly. So let's take a look and see what that does. Let's see here. Okay, so I'm going to make this bigger. I don't know if you can see it or not. Okay, so here what we have is her current age is 1. The modal premium here is $32.19, which is very affordable. I mean, that's a dinner out once a month. The death benefit here shows 100,000, so God forbid anything happened to her, in the next couple of years, but she would always have that $100,000 life insurance coverage, which is very good. So I'm going to scroll down to when she is 65 years old. As you can see, this surrender value, accumulation value, and death benefit area here, this is based on non-guaranteed. This is based on guaranteed. So even if the market was terrible and all she earned was 1% every year for the rest of her life, the policy is still going to last till she's 57 years old. Again, this is just at earning 1%. So what we're looking at is non-guaranteed. This is based on historical historical interest rates that have been earned, throughout the years. So we're going to look at guaranteed. So at age 65, here's where she's going to start taking out $12,000 a month. I'm sorry, $12,000 a year, which is $1,000 a month. That's going to be an income. Her surrender value, say she said, you know what, I don't want to mess with it, I just want to take the money out, she's going to have $222,000. If she was to pass away, God forbid, at age 65, her family would get their death benefit of $274,000. So as it accumulates, as it earns more money, the death benefit also goes up. So it's not just going to stay flat at $100,000. So all these years go by, she's living past 65, yay. You know, she hits 85 and we've only planned her retirement income for 20 years. At that point, even with her taking out $12,000 a year, she still has $541,000 worth of surrender value, meaning she could just pull that out and go and have a good time. The death benefit as well, say she passed away at age 85, she would have $592,000. That would be her insurance proceeds that would go to her family. As we keep going up, you'll see at age 93, the policy is worth over $1 million. In my family, it's not rare to live past 93. So say she's 93 and she says, you know what, I want to take the money out. I already got my retirement income. I don't have any bills. I'm old. I want to enjoy the money. So she can take out this $1 million from her policy and just enjoy her life, you know, the final years that she has. My great-grandma Abuelita, she actually lived till she was 98. So had she gotten one of these policies, or had her mom gotten a policy for her like this, at 98 she would have had $1.6 million. So that's just amazing. Again, this is a really great policy. I'm so excited that Scott and I got this for Ariana. The payment for Ariana is $32.19 a month. This is for a 1-year-old. For the kids, it's right about there, you know, maybe give or take a couple dollars depending on how much older they are. But if you want it, let me know. We can get y'all set up right away. It's a really simple application. Again, this is with Conseco. It's called the Life Options. And I just want to make sure to share this information with y'all because it's so, so, so great. So thank y'all. I look forward to hearing from you. Bye.